Hey everybody, hope you've had a wonderful start to your new year. We've had two big economic reports that have come out since the start of the year and wanted to jump into those reports for you real quickly and show you what's going on and what we're seeing in the marketplace. Let's go ahead and hop in here. So, the first thing that came out about a week ago was the big jobs report. These are for jobs created in the month of December, and it was actually a really strong report on the surface. There's two different surveys in the jobs report. If you have questions about that, you can message me and let me know. But we saw big increases: 223,000 jobs in one survey, and over 700,000 new jobs in the other survey that they performed for the jobs report. The take home message, though, or something to know about this report that doesn't make the headlines, is the majority of these job gains were people taking on part time work. And a lot of these workers were people who already had a full time job and were taking on part time jobs, probably to, pay for Christmas or make ends meet during the Christmas season. We also had people looking for full time jobs that couldn't find it, so they ended up taking a part time job instead. Because there was so much gain in part-time work, the average number of hours or the overall pay that's given to workers actually went down in December. And that was actually really good for inflation. Less hours being worked means less money in the economy, which is ultimately a good number for inflation. So normally a report like this, where we have big job gains and the unemployment rate go down, normally we would see interest rates go up. But when you break down the details and understand what's going on, this report was actually really good for interest rates, and we saw interest rates improve on this jobs report that came out, like I said, about a week ago. Also, at the end of the week, last week, we got a new CPI number for the month of December. And the hope was that since we had jobs reports coming in that tend to be deflationary or at least less inflationary, we would see an improvement in CPI. CPI did improve, but it was right in line with expectations. The data came in right at estimates for both the headline CPI and the core rate. And ultimately, it didn't change mortgage rates a lot because, again, this was expected. This was already priced in our market. So rates held pretty steady. After improving on the jobs report, they held pretty steady last week. Looking at our CPI chart here, I've showed you this before, but you can see that the CPI numbers going back a year ago are really, really high, and we're starting to replace these numbers now with lower CPI numbers. So every time we get a new CPI number, we replace an old one, and that's what's bringing the overall inflation index down. The good news is that we still have several more months of high CPI readings to replace. So January through June, the outlier, of course, being April right here, that was a little bit lower. We should, as we get more and more data, we should see less and less inflation in the economy. And we're seeing that through other data points that we have, like I said, with the jobs report and durable goods orders and things like that coming in. So the projection moving forward is still that interest rates will continue to come down from their current levels. They've already slipped down from the highest levels that we saw probably back in October or so. So the good news for buyers, the good news for real estate or people in real estate is that yes, rates are coming down, and so that should be good for the overall market. The bad news for buyers is that rates are coming down. As these rates come down, we're going to see more and more buyers enter the market. We still have a shortage of homes in our market, and that's going to create more pressure on the homes that are on market as far as staying at current prices, maybe even creeping up a little bit. We're not going to see the bidding wars that we saw back at 3% interest rates. I don't see us getting to those rates ever again, or certainly not anytime soon. But overall, the market is poised, I think, for a solid year of real estate appreciation, and a lot of that will be driven by interest rates, which we do anticipate going down. Looking ahead this week, guys, there's really not a lot of economic news on the calendar this week. But starting next week, we get another crack at inflation with personal consumption expenditures, or the PCE report. And of course, a week and a half from now, we'll keep you updated. The Fed's first meeting of the year is February 1st. We're anticipating a quarter point rate hike on that meeting. And we'll break all that down for you. Be sure to subscribe, like these posts. If you have any questions, let me know. We'll help you out as best we can. But for buyers, please know that as these rates come down, the competition is going to ratchet up. Certainly think now's the best time it's been in years to negotiate for a house. and that window I do think will be closing between now and spring. So certainly, if we can help you out with that, let us know. Hope you guys have a wonderful day. Happy MLK Day, and we'll do another one of these updates here in a few weeks.